So I hope you enjoyed that overview of partnership tax. Now I want to stress again that that video is meant to be a broad, high-level overview of what we're going to cover this semester. And some of the topics we're going to cover this semester were not in that video because they are considered more in depth. For example, allocations. But in no way do I expect you to know everything from that video. Again, I did that to give you a high-level overview understanding of how everything we're going to do this semester fits together, so you have it at the beginning, and then as we go throughout the semester, and then at the end, it closes the loop, or all the pieces of the puzzle come together. So keep that in mind. And if you ever get lost in what you're doing in the semester, always come back to this module because you see all the pieces, how they fit together. All right, so with that, we're going to go ahead and we're going to jump into our first topic. Woo, yeah! All right, so we're going to talk about classifying a partnership. The starting point of partnership tax is always to determine if you even have a partnership for federal tax purposes. Now, we're going to go through a video in a few minutes about how exactly to do that and why it's important. But one thing I want to stress to you is just because you have a partnership for state law purposes or you don't have a partnership for state law purposes does not mean you do not have or do have a partnership for federal tax law purposes. That is a huge element. So keep that in mind. And we go through that discussion, okay? I have a step process. One of the things I like to do when you have difficult areas of the tax law, especially like in partnership tax, I love to use checklists, steps, or various charts to help you navigate these difficult areas of the law. So you're going to have a checklist approach, I love checklists, to getting through and classifying an entity. Now, whenever I teach a business entity taxation course, I always start with this topic. So this topic is actually the same topic I use in my corporate tax class. And you're saying, well, why exactly is it the same topic? It's because if you have some arrangement, some contractual relationship, or some type of entity under state law purposes that you're trying to determine, hey, how is this tax for federal tax purposes? It's always the same analysis. It's the same step-by-step approach. So keep that in mind. All right. So some of you might be wondering, well, you probably saw that, right? Oh, remember, I like to get animated. I got some costumes. Something's coming up in a minute, right, for me to demonstrate what's going on. So you might be wondering, well, if somebody is classified as a partnership versus, let's say they're a disregarded entity, I'm sorry, not disregarded entity, versus there's no partnership for all tax purposes, and it just flows through Schedule C's on the various owners or various members of this business entity, business association or arrangement, we should say, not entity. I should be careful, right? Don't say entity, say arrangement, right? The idea here is, let me step back. Let's say that you enter into a contract with your friend and you all are going to buy a residential home and you're going to rent that residential home out, okay? And in no way did you file to be a partnership or any type of entity for state law purposes. Now you're probably wondering, well, why would you ever do that, right? Because of limited liability and various protections and other reasons outside of tax that generally you're advised to form an entity, and you're right. But this does happen, and you have clients that come to you and they say, hey, this already has happened, and you have to determine what's going on. And it also helps you understand what's going on when it comes to partnership tax, okay? Subchapter K of the Internal Revenue Code found in the 700s, that's where partnership tax applies, okay? Well, that arrangement, right? Notice I said contractual relationship. I never said entity. That arrangement may or may not be classified as an entity for federal tax purposes, and if it's an entity, it may or not be classified as a partnership. So there's different levels, and that's why we have these steps. So let me just take two different examples, okay? And I'm going to explain why it matters, and you're going to see that costume pop up in a moment I just had in my hand. You probably saw that, right? Getting excited. So on one hand, that contractual relationship between you and your friend, it might be considered not an entity, but a business activity. Let's say it rises to the level of business activity under trade or business under Section 162 for each of you, and you both consider it because there's no entity for state or federal law purposes, a disregarded entity flowing through to your Schedule C on your 1040. And then whatever income you take in, you report that based on contractual relationship, and then your friend the same thing on his or her 1040. Well, in that situation, you're accounting for the items and what's being reported under your methods of accounting. Various elections that occur are based on yours, and then your friend's portion of income, expenses, deductions, all those things, credits, same thing for them on theirs. Let's now classify what happens. Let's turn the table over, other side of the coin. Let's say it's going to be determined to be an entity for federal tax purposes, specifically a partnership. You two, I have partnership for federal tax purposes. You're going to learn the video, right? More than one owner, has to be more than one owner. It's classified as a partnership. Well, in that situation, the partnership is going to have its own method of accounting separate from the owners. It's going to have its own separate tax year separate from the owners. And different elections, such as involuntary conversion, installment sale. These things are elected at the partnership level, not the individual owners. And that makes a huge difference, okay? Section 1033 involuntary conversion election, boom, it's done at the partnership level, not the owners. That makes a big difference. So of course, there can and cannot be differences with respect to situation one, right, the sole proprietorships and flow through on Schedule C of the 1040 versus the partnership, which subchapter K of the partnership tax law applies. It may or may not result in the same situation, but there could be differences. And I gave you some big ones. For example, again, the partnership is the one that determines the method of accounting and when stuff is reported. The partnership has its own tax year, not what the partners are. Could be the same, might not be. And also elections. And those are just some examples. There's other examples. Now, this idea of, and the reason why it makes a difference. So you might be, again, wondering when you're thinking about this topic, our first topic, right, classification entity, why does it make a difference? It makes a difference because, again, it could affect things in situation 1 verse 2 in various scenarios under the tax law, under the income tax law. Another element of that comes into subchapter K, partnership income tax law, and the overarching ideas. And we're going to be emphasizing these overarching ideas throughout the semester, okay? In my talking head videos, you're going to see I'm going to be coming back to these topics, so keep this in mind, as well as in the actual discussion videos, the lecture videos, the problems, you're going to see it as well. We have a continuum. On one side of the continuum, we have the entity theory of partnership taxation. On the other side, we have the aggregate theory of partnership taxation. And that example I had earlier, right, of what could happen with this classification of this relationship between you and your friend, right, contractual relationship, where it could be either no entity treated on your own 1040 Schedule C, or it could be an entity where you have to file a Form 1065 for the partnership for federal tax purposes. The entity theory basically says, hey, we're going to treat this partnership as an entity like a corporation, where it's a completely separate entity from the owners. The aggregate theory says, no, no, no. Partnerships are flow-through entities, as you all know. I'm sure you already know that. They're flow-through, meaning there's no double taxation like a C corporation, right, in the entity theory. The aggregate theory says flow-through, so everything should just flow through to the owners, so the owners should use their own methods of accounting in their own year and do their own elections. So we have this struggle between the entity theory of taxation and the aggregate theory, and you're going to see this come back and back throughout the semester because some rules we apply the entity theory, method of accounting, what partnership year end is. We're going to see that later on, okay, and how the rules work. But other things, aggregate theory. For example, separately stated items that flow through to the owners. That is an example of the aggregate theory, okay? We're going to see this throughout the semester. So now you get to see my costume, and this costume actually matches my white and black referee outfit, right? This is a penguin hat. Yes, see the penguin? This is a penguin hat. This is my penguin costume. I don't actually have a full costume. I mean, I guess you could say, you know, I have the black and white shirt, right, with the white pants, so I'm kind of wearing a penguin costume. This is my penguin costume. And you're saying, well, what does a penguin have to do with a partnership, other than both starting with the letter P? So some tax practitioners, academics, and professionals, they equate partnership taxation to a hybrid, like a penguin. A penguin is a hybrid. It's, of course, the classification is under the bird, but there's elements of a penguin that are kind of more like a fish than a bird, okay? Like, it spends a lot of time underwater. If you ever touched a penguin, I've actually had the chance to go to one of these aquariums and touch, for a very short period of time, a penguin, and the feathers feel much different than like a chicken or any type of normal flying bird. Well, there's some elements of a penguin that are more like a bird and others that are more like a fish, okay? So it's like a hybrid. It's like a combination. It has elements of the entity and aggregate theories, okay? We know a partnership for federal tax purposes is an entity, okay? Just like a penguin is a bird. It's classified as a bird, but there are some elements that make it more like it could be considered more like a disregarded aggregate theory, okay? So keep that in mind. That is the penguin or hybrid theory of partnership taxation, and that has to do, again, with the entity versus aggregate theory of partnership tax. Here's another penguin. So there's different types of penguins. This is it's got some nice hair, different penguin hat. But that is the penguin theory of taxation. All right, so now we're going to finish off this video by looking at the rules, the checklist on how exactly we classify an entity, going through step by step. A very, very important video. And then we're going to put that in use by going through a problem or a few problems that bring up some of those concepts and why it makes a difference and why it's important. All right, so you're going to have a great time with that material. It's very, very important for the rest of the semester, so please keep that in mind, and let's get to it.